Option selling. It is the best gig in the world. No customers, no employees, and you get paid every single week. If when you sell puts, you're committing to buy a stock if it drops below a certain value. If you have to buy the stock, then you sell a covered call against it. And what you're doing is you're committing to sell your shares if it goes above what you paid for it. And you're just creating yourself weekly income. So check it out. Watch this video to the end. I'm going to walk through an example and I'm going to use DJT and I'm going to walk through selling a put and selling a covered call. Now, DJT, this is the Trump Media Company. I don't think I ever traded this stock. It's fairly new. It came out about a year ago or so. And how many people out there are pro-Trump? How many people out there are anti-Trump? I want to get a lot of controversy in this video. Hit me up in the comments. Are you pro-Trump or anti-Trump? Who cares about Trump? Let's just take a look at his stock. Now, the cool thing about DJT stock is that Trump owns the majority of the shares. And whether you like Trump or don't like Trump, I think we can all probably agree that his ego is pretty big. So I view that as a very low likelihood of, let's say, the stock going out of business. I'm going to share my screen and we're going to take a look and dive right in. Okay, so the first thing that we always want to look at is a chart anytime we're looking at a stock, right? So this is a 1-year chart. This is my own trading platform, Thinkorswim. And one thing that you'll notice right off the bat, it's been kind of sideways. So for the past, like, I would say 3-4 months or so, it's been kind of trading in this sideways channel. Sideways activity is pretty good because I'm going to show you what if we sold us a put, and I'm going to show you what if we sell a covered call, and what if you do them both at the same time. So this stock, first of all, is only about $17 per share. So you see the stock price right here, $17.34. So it's very, very inexpensive, which is kind of cool because a lot of people ask me on this YouTube channel and they say, hey, I got a small account, or hey, I want to start trading. I want to start off small. How can I start? This might be for you. Now, I'm not suggesting this stock. I'm just kind of giving you different ideas, and I'm telling you how trading works and how selling options work. So let's jump right in. So first, we're going to look at selling a put. What does a put mean, people? So basically, what selling a put means is that we are committing to buy the stock if it goes below a certain price before the expiration date. I always look at 1 week expiration dates. Why? 2 reasons. Number one, I don't know what the market's going to do, and I don't want to tie up my capital for extended periods of time. And number two, I want to create income for myself each and every single week. It's who doesn't like getting a check in the mailbox once a week? I mean, yeah. So check it out. So the stock right now is $17.34. So I am going to look at, let's say, a $17 put. Now, strikes are down the middle and puts are on the right-hand side of the page, and it last traded at $32 per share. Now, we're always going to calculate the rate of return. So let me pull up a calculator here. All right, and we're going to not assume any margin, right? Let's take a look and see what kind of rate of return we can get on this kind of trade. So a $17 put, and by the way, that has volatility is actually quite good, 53% volatility. So the higher the volatility, the more swing a stock has. And the more swing a stock has, it's kind of good because when you sell puts, if and when you get assigned the shares, you can sell covered calls against them. The higher the volatility, the more premium typically that you make. So that's advantageous to option sellers like us. We're also going to look at the delta here. The delta is kind of like the statistical likelihood that the stock is going to close below the strike price by the expiration date of October 10th. So I'm going to look at a $17 put. It last traded at $32. I'm going to divide 32, which is our premium, divided by 1,700. That's the amount of capital we'd have to put up to make this trade. Why? Because if we're selling a $17 put, each contract always has 100 shares. 17 times 100 shares is $1,700. That's the amount of money that we need to make this trade if we're not using margin. We're not going to talk about margin in this particular video. So we're going to get a rate of return of almost 2%. But remember, this is for only 1 week, right? Because this is an October 10th expiration date. So we're always going to annualize our rate of return out. So we do that by multiplying by 52 because there's 52 weeks in a year. And that gives us an annualized rate of return of almost 100%. That's pretty good. What does that mean? That means that, let's say if you have an account that's 10,000 bucks and you're making 100% on your money, your 10K is going to make about 10K per year. But instead of buying a stock and hoping and praying that it goes up and then selling it to capture the gain, you're actually capturing the income each and every single week. Not so bad. Let's take a look at the covered calls as well, because here's the thing, guys. You can sell a put and you can sell a covered call at the same time. What's a covered call? A covered call means you already have the shares, or you're going to buy them right now, and then you're going to sell a call that's over than what you paid. So for example, let's say I don't have any DJT stock and I want to buy some on Monday morning when the market opens. And I'm going to pay $1,734 for 100 shares. Then right away, I'm going to sell a 1750 call. Why 1750? Because I want to make as much premium as possible. I don't really care so much about stock appreciation. I care about the cash flow in my pocket because that sustains my lifestyle, right? So I'm going to sell a 1750 call, and that last traded at $41, right? That's where it traded last on Friday before the market closed. So I'm going to make $41 on this trade. And how much am I going to put up? I'm going to put up $1,734 because right now it's trading at $1,734 per share. And that gives us a rate of return of a little bit more than 2%. But again, just like with the put that we just talked about, it's only for 1 week. So we're going to multiply by 52. And we're going to get an annualized rate of return of 122%. Not too shabby. Now, one thing to notice if we go back to the chart is that if we hover over these little icons, it shows your earnings per share for the stock. And you'll see a negative amount in the most recent earnings and a negative amount in the earnings prior to that. And then the earnings prior to that is also negative. So that means that the company is in itself actually not making a profit. That doesn't necessarily mean it's bad. I mean, I personally traded Tesla for a long, long time before that was a profitable company. So anyway, that's how easy it is to sell a put and sell a covered call. If you like this video, hit the like button, subscribe to my channel. I'm putting up a video each and every day. Sometimes I walk through different types of stocks. I talk about selling puts. I talk about selling covered calls, all things options. Why? Because it's so amazing to create yourself systematic weekly income. Anyway, cheers for now.